Late Friday night, May 1st, most of Washington had already left for the weekend, and while the rest of us were closing our laptops, two senators quietly released the text that could decide whether the United States passes its first comprehensive crypto market structure bill in 2026, or whether we watch the window close until 2030. The fight that has stalled the Clarity Act for almost 5 months is finally on paper. The line between what crypto platforms can offer and what they can't has been drawn, and the next 30 days will tell us whether the bill becomes law or a footnote. I'm Dr. Tonya M. Evans, and this is Confidently Crypto. Welcome back to Confidently Crypto. I'm your host, Dr. Tonya M. Evans, digital asset regulatory strategist, occasional law professor, board member at one of the largest digital asset companies in the world, and author of Digital Money Demystified, the cooperative economics of crypto, and electing crypto. This show exists to help you whether you are crypto curious, an investor, a legal or financial professional, or someone who just knows this technology matters but doesn't know where to start, how to navigate in the digital asset economy, and to do so with clarity and confidence. So this is your spot. No hype, no jargon, just the real story every week. A quick programming note before we dive in. Today's episode is the last Monday show. And starting next week, the Confidently Crypto segment is moving to Fridays. So the next episode drops Friday, May 15th. And from there forward, look for new episodes to drop every Friday. Same show, new day. So set your reminder. And if you subscribe, I hope you do. Wherever you get your podcasts, the new episodes will land in your feed automatically. Now, today we're going to walk through what just happened with the crypto market structure bill, referred to as the Clarity Act, what is actually in the compromise text that dropped this past Friday, May 1st, and what the next 30 days mean for your money, your practice, or your portfolio. So let's start, as we always do, with this week's state of crypto. Bitcoin is trading right around $76,700 as I record this, according to data from CoinMarketCap and across major exchanges. The Crypto Fear and Greed Index sits at 26, which puts us squarely in fear territory, though that is up from the extreme fear readings of 8 to 12 that we saw in early April. Ether is hovering near $2,270. And the total crypto market cap is sitting around $2.6 trillion. And here's the part that matters. April was the strongest month for spot Bitcoin exchange traded fund inflows since October of last year. And that's spot Bitcoin ETFs, according to multiple market reports. In fact, $2.4 billion in net flows to be exact. Cumulative inflows since the funds launched in January of 2024 now stand at $58.5 billion. BlackRock's iShares Bitcoin Trust, or IBIT, alone holds roughly 812,000 Bitcoin. So even with retail sentiment and fear, institutional money keeps flowing in. That divergence is the real story underneath the price. And now to the headlines that matter for the rest of today's episode. First, the headline on Friday night, May 1st, the Senate Banking Committee released the Clarity Act compromise text on stablecoin yield. And that is the single issue that has blocked this bill from moving for almost 5 months. The deal was brokered by Senator Tom Tillis, Republican of North Carolina and member of the Senate Banking Committee, and Senator Tillis-Alsobrooks, Democrat of Maryland, and also a member of that same committee. CoinDesk reported the text dropped late Friday and updated the story through the weekend. By Saturday afternoon, crypto trade groups, including Coinbase and Circle, had publicly backed the compromise and called for the Senate Banking Committee to advance the bill. Coinbase CEO Brian Armstrong posted a reaction on social media, short but sweet, mark it up. The Senate banking markup is now expected the week of May 11th, and we'll spend most of today's episode unpacking what is actually in that text. And by the way, if you missed our deep dive on Senator Alsobrooks 2 episodes ago, the one on the unlikely champions of crypto in the Senate, go back and listen. The work she has been doing on this bill is one of the most underreported stories in this entire process. Second, Senator Bernie Moreno, Republican of Ohio, and another member of the Senate Banking Committee, has set an explicit end of May deadline. If the bill doesn't clear the Senate Banking Committee before Memorial Day recess on May 21st, industry analysts at Galaxy Digital and other research firms say the realistic path to passage in 2026 closes. Polymarket, which is a real money prediction market that aggregates bets on policy outcomes, currently has the odds at just 47% for the bill being signed into law this year. And that's down sharply from 82% in February. So the clock is real. Third, Western Union confirmed during its first quarter earnings call last week that its dollar-backed stablecoin called USDPT will go live this month on the Solana blockchain. Initially, it will be used only for back-end settlement with Western Union's global agent network, replacing parts of the SWIFT messaging system. And SWIFT, by the way, stands for the Society for Worldwide Interbank Financial Telecommunications. It's a mouthful, but you might be more familiar with the common acronym SWIFT. And it is the messaging network that banks have used for over 50 years to tell each other to move money. So it's an electronic messaging system. Western Union is now testing whether a stablecoin can do that job faster, cheaper, and 24/7, 365 around the clock. So we're going to do a full episode on what that means for the unbanked and underbanked next Friday, May 15th. And I'll actually be recording that episode live from Bermuda, where I will be attending Penrose Capital's FinTech Forum. So stay tuned for that. All right, now let's get into today's main event. Let's do some level setting on what the Clarity Act actually is, because this is one of the most consequential pieces of crypto legislation in U.S. history. And most people, if they know it at all, only know it as a name. The Clarity Act is the bill that would finally resolve the long-running turf war between two of the most powerful financial regulators in the country. Those agencies are the Securities and Exchange Commission, or SEC, which oversees stocks, bonds, and other investment securities, and the Commodity Futures Trading Commission, or CFTC, which oversees commodities markets like oil, wheat, and gold. For years, both agencies have claimed jurisdiction over different parts of the digital asset economy, which has really left companies, investors, and lawyers operating in regulatory limbo. The Clarity Act would put commodity-like tokens, including Bitcoin, under the CFTC, and it would put security-like tokens under the SEC, and it would create a clear registration path for digital commodity exchanges, brokers, and dealers. And it would settle in statute rather than through regulatory enforcement what crypto firms can and cannot do in the United States. Now, the House passed its version of the Clarity Act back in July of 2025 with 294 votes. The Senate Agriculture Committee passed its version in January of this year, and the only thing standing in the way of the Senate Banking Committee version has been one fight: stablecoin yield. And here's the dispute really in plain language. So first up, a stablecoin is a digital token designed to maintain a stable value, usually pegged to another asset. Most stablecoins you'll hear about are pegged to the US dollar on a 1-to-1 ratio. Think USDC from Circle or the new USDPT from Western Union. But stablecoins can also be pegged to other currencies like the euro, to baskets of multiple currencies, or even to commodities like gold. And the Clarity Act and the Genius Act focus primarily on dollar backed payment stablecoins, which is why those are the ones we're going to focus on today. And the Genius Act, signed into law back in July of last year, established the federal framework for those dollar pegged tokens requiring full reserve backing and regular audits. Now, a quick definitional note before we go any further, because you will hear me use the words yield and interest, and the difference between them is at the heart of this whole entire fight. Interest, in the traditional banking sense, is a specific type of payment. It's money paid by a borrower to a lender for the use of money. Let me say that again. Interest is money paid by a borrower to a lender for the use of money. And when you deposit cash into a savings account, the bank is essentially borrowing your money to lend it out. And they pay you interest in return for that privilege. Yield it's a broader term. Yield is the return you earn on an investment, expressed as a percentage. And it can come from many different sources. It can come from interest, but it can also come from dividends on stocks, from rewards for staking crypto, from transaction fees, and from a whole range of other activities. So think of it this way: all interest is yield, but not all yield is interest. The crypto industry has been offering payments on stablecoin balances and calling it yield. The banking industry has been arguing that those payments function economically like interest on a deposit, which would put crypto platforms in direct competition with banks for those same dollars. The Tillis-Alsobrooks compromise is essentially Congress drawing a line between the two. The fight was over what crypto platforms can pay you for holding those stablecoins. The banking industry said any meaningful yield on stablecoin balances would pull deposits out of community banks and threaten the lending capacity that local economies depend on. They called it deposit flight. And the crypto industry said restricting yield would push the entire industry offshore and make the United States less competitive in global digital asset markets. That dispute is what blocked the Senate Banking Committee markup in January. That dispute is what stalled the bill for almost 5 months. And that dispute is what was finally resolved on paper Friday night. And here's what the Tillis-Alsobrooks compromise actually says based on the text reported by CoinDesk and FinTech Weekly. Stablecoin issuers and the digital asset service providers that work with them, including exchanges, brokers, and affiliated entities, are prohibited from offering yield directly or indirectly on stablecoin balances if that yield is the functional or economic equivalent of bank interest. The prohibition is broad by design. It closes workarounds through affiliates and structured arrangements. And there's also explicit anti-evasion language in the text, meaning lawmakers anticipated that platforms would try to engineer around the rule, and they wrote the statute to prevent it. But, and this is the part of the crypto industry really wanted, activity-based rewards tied to payments, transfers, and active platform use are still permitted. Cashback style programs, transaction-based incentives, rewards for actually using stablecoins in commerce, they remain in the toolbox. The compromise framework gives the Treasury Department and the CFTC 12 months after the bill becomes law to write the specific rules defining what counts as activity-based versus passive. So The TLDR in plain language, if you just park your stablecoins on a platform like a savings account, no payments. But if you actually use them, well, the platform can actually reward you. One industry observer has put this as a shift from buy and hold to buy and use. And that is the new bright line. Now, here's the one thing about all of this. While Washington argues over what platforms can pay you for holding stablecoins, the question I keep coming back to is who is holding your keys, your control? Because if your crypto sits on a centralized platform, you don't actually own it. You have a claim on it, and every regulatory fight, every market structure debate, every yield dispute comes back to the same fundamental question. Do you control your own assets? And that's why I trust SecuX for metal seed phrase backups. Your seed phrase is the only thing standing between you and permanent loss. Paper burns, paper fades, paper gets thrown out by accident or on purpose. And SecuX makes stainless steel backups that survive fire, water, and time. So if you're serious about long-term crypto holdings, you need a long-term backup. Get yours through my affiliate link at proftonyaevans.com/partners. That's PROFTONYAEVANS.com/partners today. So the line, it's drawn. Now let's talk about what this actually means for you. If you're an investor, here's what changes. The savings account style stablecoin yield products that some platforms have been offering, where you simply deposit and earn returns passively, those days go away if this bill becomes law. And that's by design. The compromise was specifically built to protect community bank deposits from migrating to crypto platforms. So if part of your strategy was parking stablecoins on a platform for passive yield, you need to understand that that revenue stream is on a regulatory timer. And what replaces it? Activity-based rewards. So think cashback programs for using stablecoins to pay for things, transaction incentives for sending payments, rewards tied to actually moving money rather than just letting it sit. And this is closer to how credit card rewards work today. Platforms will compete on transaction value rather than deposit interest rates. And there's a second thing worth understanding because the framework gives the Treasury Department and the CFTC 12 months from enactment to write the specific rules. So even if this bill passes in summer or fall, the actual enforcement of what counts as activity-based versus passive, it won't actually be settled until well into 2027. So there's going to be a transition period where platforms test the boundaries and regulators push back, so plan accordingly. And if you are a financial professional, your clients are going to start asking you about this. The questions will sound simple. Can I still earn yield on my stablecoins? What's changed? Should I move my crypto somewhere else? And you need to be able to answer them with both the legal reality and the practical implications. And you need to be able to do it without sounding like you're reading from a press release. And if you're a lawyer, particularly one advising fintech clients, payment companies, or any business touching digital assets, the rulemaking window that opens after enactment is going to be one of the most consequential periods of crypto policymaking in a decade. The statute sets the framework. The rules will determine the outcome, and your clients will need counsel who understand both. And if you're someone who has been waiting for the United States to settle its crypto rules before getting more involved, this is the bill that you have been waiting for. And clearly it's not perfect. Whatever is ultimately signed into law won't be perfect, whatever that means. No legislation ever is, but it is the most comprehensive market structure framework Washington has ever produced. And it has bipartisan support that even the bankers and the crypto industry have grudgingly come to accept. And here's something worth saying out loud since we're on this topic. None of this regulatory fight changes the fundamental case for self-custody. Whether the Clarity Act passes in May or in 2030, God forbid, whether stablecoin yield is permitted or prohibited, whether your platform is regulated by the SEC or the CFTC, the principle stays the same. Not your keys, not your coins. And that's why I recommend Ledger for cold storage. And cold storage means your private keys that you manage, your cryptographic codes that prove you own a digital asset, and it never touches the internet. It actually exists on a hardware device that you control, and exchanges can fail. We've seen that time and time again in the headlines. Platforms can be sanctioned, regulations can change overnight, but what's stored on your Ledger device, that stays yours. If you've been thinking about taking self-custody seriously, start at proftanyaevans.com/partners to learn more about Ledger and how you can take ownership and control of your crypto. And now the most consequential part of this episode, the yield compromise that unblocks the bill. But it doesn't finish the bill, and there's still some real disputes that have not been publicly resolved. First is the ethics provision. Senate Democrats have been pushing language that would prohibit the president, the vice president, members of Congress, senior government officials, and their immediate families from issuing, promoting, or profiting from digital assets while in office. And this, of course, is in direct response to the Trump family's expanding crypto holdings, which now include a meme coin, Bitcoin mining company, the World Liberty financial platform, and a stablecoin called USD1. Democrats have signaled pretty strongly that they may withhold votes on the Clarity Act unless ethics language is included. Republicans have signaled the ethics provisions will not be in the banking committee version, but might be added later. So that fight is looming large and it remains unresolved. The second is decentralized finance, or DeFi. Senate Democrats have raised concerns about DeFi posing vulnerabilities to bad actors, particularly around money laundering and sanctions evasion. The compromise around protocol developers versus intermediaries that handle user funds is still being negotiated, so stay tuned for that. The third is Republican vote count. Senator Tim Scott, Republican of South Carolina and the chairman of the Senate Banking Committee, told Fox Business he is working to secure all 13 Republicans on the committee before scheduling the markup. The reporting from Punchbowl News and also CoinGape names Senator John Kennedy, Republican of Louisiana, and a member of the Senate Banking Committee as one Republican who is not yet committed. Without 13 of 13 Republicans, the bill could still advance, but the path becomes more difficult. And now the calendar. The Senate Banking Committee markup is expected the week of May 11th. If the bill clears committee, it then needs to be reconciled with the Senate Agriculture Committee version that passed in January. And then it needs 60 votes to clear the full Senate floor, which means meaningful Democratic support is required. And then it needs to be reconciled with the House version that passed last July because the Senate's text is materially different. And then it needs the president's signature. So that's a lot of thens. Then the Senate breaks for Memorial Day recess on May 21st. And after that, between FISA reauthorization, the Department of Homeland Security funding, the budget resolution, Kevin Warsh's nomination to chair of the Federal Reserve, the floor time becomes unbelievably scarce. By August recess, it becomes near impossible. And by November midterms, the political environment changes entirely. Senator Bernie Moreno has been quite blunt. The end of May, Senator Cynthia Lummis, Republican of Wyoming and the chair of the Senate Banking Subcommittee on Digital Assets, said at the Bitcoin 2026 conference that markup will happen In May, Chairman Scott said the bill is, quote, in the red zone, and all three are saying the same thing in different words. The next 30 days decide whether this bill becomes law in 2026 or sits on a shelf until the next administration, the next Congress, and a regulatory environment we cannot predict. Here's something that is going to matter more than people realize once this bill passes. Activity-based rewards are not the same as passive yield, and the IRS is going to treat them differently. If you're earning rewards for transactions, payments, or active platform use, every single one of those events is potentially a taxable event. And that means you need to track your cost basis, which is the original price you paid for the asset, the fair market value at the time you receive the reward, and how to categorize it for tax purposes, whether ordinary income or capital gains. And starting this year, brokers are required to issue Form 1099-DA for digital asset transactions, which means the IRS is getting that information whether you track it or not. This is why I use and recommend CoinTracker. CoinTracker connects directly to the platforms and wallets you actually use. It calculates your cost basis automatically. It generates the tax reports your accountant needs, and it does so across exchanges, wallets, and DeFi protocols, so you aren't stuck reconstructing a year of transactions from screenshots back in March. Whether you are an active investor managing a real portfolio or a professional who needs to understand crypto tax mechanics for your clients, CoinTracker is absolutely the tool that I recommend, especially as activity-based rewards become a bigger piece of the stablecoin economy. You'll want to set this up before you need it, not after. Get started at proftanyaevans.com/partners and be sure to click on my link. Now, let me speak directly to the law students and the early career attorneys listening or watching now, because this summer is the moment. Everything we just walked through, the Clarity Act compromise, the rulemaking window, the activity-based versus passive distinction, the ethics provision, the DeFi negotiations, this is the regulatory architecture that will define U.S. digital asset law for the next decade. The lawyers who understand it will be the lawyers building practices around it. The lawyers who don't will be sitting on the sidelines while their clients ask someone else. So I built the Web3 Ready for Law Students Intensive for exactly this moment. It's a 4-week live summer cohort that compresses what I teach over 14 weeks during the academic year into a high-touch, transformation-focused format. Crypto law foundations, smart contracts and tokenization, compliance, custody, and client advising, career strategy for a practice area that didn't exist 5 years ago, live sessions online, downloadable frameworks, peer cohort community interaction, and a Web3 Ready certificate of completion when you finish. So here's how to get started. Visit proftanyaevans.com/beyond the JD. That's beyond the JD for Juris Doctor. And download the free Web3 Ready for Law Students guide. And when you opt in, you'll also get full information on the program application process, including seat deposit options to lock in the best rate should you be accepted into the program. This is a curated cohort with limited seats for maximum engagement. So the application matters, and so does the timing. And once seats fill, the next opportunity is a full year away. I only run these during the summer. So visit proftanyaevans.com/beyond the JD. Get your free guide, the application details, learn more about the seat deposit. That is the path. So here's where we land. The Clarity Act is not yet law. The compromise text is not the final text. The Senate Banking Committee markup has not happened yet. The reconciliation hasn't happened. The floor vote hasn't happened. The president's signature, it hasn't happened. But The single biggest substantive obstacle that has blocked this bill for almost 5 months is now resolved on paper. The line between passive yield and activity-based rewards is drawn. The bipartisan coalition that the bill needs to pass the Senate is still intact, and the May calendar gives this legislation its last realistic window before the midterms consume Washington's attention entirely. Whether you're an investor, a professional, or someone just trying to understand what is happening to the financial system, pay attention to the next 30 days because what gets settled in May determines what your relationship with the digital asset economy looks like for years to come. If this episode helped you make sense of what just happened, share it with someone who needs to understand it as well. Subscribe wherever you get your podcasts. Be sure to leave that 5-star review and help us build this show for more people who actually need it. Subscribe to the DMD Digest Investor on Substack for weekly insights at the intersection of crypto, regulation, and economic justice. And visit ProfTonyaEvans.com for everything else, including the Web3 Ready for Law Students guide and the full Beyond the JD ecosystem, Web3 Ready for Lawyers, Web3 Ready for Professionals, and more. And a reminder before we close, today is the last Monday show. Starting next week, the Confidently Crypto segment on Financially Speaking podcast moves to Fridays. Same show, new day. The next episode drops May 15th. That's Friday, May 15th. And I will be recording it live from Bermuda at the Penrose Capital FinTech Forum. We'll be unpacking the launch of Western Union Stablecoin and what it means for the unbanked and underbanked here at home and around the world. Until then, I'm Dr. Tonya M. Evans, and this is Confidently Crypto, where you get the real story behind the crypto headlines and the strategy to act on them. Stay informed, stay prepared, and stay confidently crypto.